businesses, and local communities. The potential for immediate and significant impacts on the broader banking system and the economy. The situation demanded a swift response. In the days that followed, the federal government took decisive actions to strengthen public confidence in the U.S. banking system and to protect the U.S. economy. On March 9th, depositors at Silicon Valley Bank withdrew $42 billion in deposits in a period of just a few hours. After concluding that significant deposit withdrawals would continue the next day, the California state regulator closed SVB and appointed the FDIC as receiver. 2 days later, the New York regulator closed Signature Bank, which also had experienced a depositor run, and appointed the FDIC as receiver. Treasury worked to assess the effects of these failures on the broader banking system, consulting regularly with the Federal Reserve and FDIC. On Sunday evening, recognizing the urgency of reducing uncertainty for Monday morning, Treasury, the Federal Reserve, and the FDIC announced a number of actions to stem uninsured depositor runs and to prevent significant disruptions to households and businesses. First, the boards of the FDIC and the Federal Reserve recommended unanimously, and Secretary Yellen approved after consulting with the President, 2 actions that would enable the FDIC to complete its resolutions of the 2 banks in a manner that fully protects all of their depositors. These actions ensured that businesses could continue to make payroll and the families could access their funds. Depositors were protected by the Deposit Insurance Fund. Equity holders and bondholders were not protected. Second, the Federal Reserve created the Bank Term Funding Program, a new facility to provide term funding to all insured depository institutions eligible for primary credit at the discount window, based on their holdings of Treasury and government agency securities. This program, along with the pre-existing discount window, has helped banks meet depositor demands and bolstered liquidity in the banking system. This 2-pronged targeted approach was necessary to reassure depositors at all banks and to protect the U.S. banking system and economy. These actions have helped to stabilize deposits throughout the country and provided depositors with confidence that their funds were safe. In addition to these actions, on March 16th, 11 banks deposited $30 billion into First Republic Bank. The actions of these large and mid-sized banks represent a vote of confidence in the banking system and demonstrate the importance of banks of all sizes working to keep our economy strong. Moreover, on March 20th, deposits in certain assets of Signature Bridge Bank were acquired from the FDIC, and on March 26th, the deposits in certain assets of Silicon Valley Bridge Bank were acquired from the FDIC. We continue to closely monitor developments across the banking and financial system and to coordinate with the federal and state regulators. As Secretary Yellen has said, we have used important tools to act quickly to prevent contagion, and they are tools we would use again to ensure that Americans' deposits are safe. Looking forward, while we do not yet have all the details about the failures of the 2 banks, we know that the recent developments are different from those of the global financial crisis. Back then, many financial institutions came under stress because they held low credit quality assets. This was not at all the catalyst for recent events. Our financial system is significantly stronger than it was 15 years ago. This is in large part due to the post-crisis reforms for stronger capital and liquidity. As you know, the Federal Reserve announced a review of the failure of SVB and the FDIC a review of Signature Bank. I fully support these reviews and look forward to learning more in order to inform any regulatory and supervisory responses. We must ensure that our bank regulatory policies and supervision are appropriate for the risks and challenges that banks face today. Thank you to the committee for its leadership on these important issues, and for inviting me here to testify. I look forward to your questions.
Thank you, Ms. Lang. And almost every member of this committee will be here today on both sides of the aisle. Make your answers as brief and as quick as you possibly can. So thank you for that. In 2019, by votes of 4-1 and 5-1, now chair of the NEC, Leo Brainerd, the only dissenter in every one of those votes, the Fed rolled back stronger rules and was responsible for supervising Silicon Bank. Mr. Vice Chair Barr, did the Fed drop the ball because it didn't see the risk that was building?
Thank you, Chairman Brown, for that question. Fundamentally, the bank failed because its management failed to appropriately address clear interest rate risk and clear liquidity risk. That interest rate risk and liquidity risk was highlighted by the supervisors of the firm beginning in November of 2021. The board the Federal Reserve Bank brought forward these problems to the bank, and they failed to address them in a timely way. That exposure led the firm to be highly vulnerable to a shock, and that shock came on the evening of Wednesday, March 8th, when it very belatedly attempted to adjust its liquidity position and reported losses on its available-for-sale securities. The market reaction to that was quite negative, and that eventually on Thursday sparked a depositor run.
So some of their practices appear to have violated the basic principles of Banking 101, concentration risk, over-reliance on uninsured deposits, inadequate liquidity, poor risk management, the list goes on. How poorly managed was this bank?
Supervisors had rated the bank at a very low rating. Normally, we would not be describing these matters, confidential matters, but given that the firm failed and triggered a systemic risk determination, I'm prepared to talk about that confidential information. That the firm was rated a 3 in the Campbell scale, which is not well managed. And at the holding company level, it was rated deficient, which is also clearly not well managed.
Okay, thank you. Chair Gruenberg, I heard from many small businesses over that weekend who had money in SVB and were worried about making payroll in Ohio, making payroll as a result of the failure. I heard from Ohio small banks and credit unions worried about deposits leaving their institutions. I know that I'm not unique. Many of my colleagues from both sides of the aisle heard those same concerns in their state. Given the unprecedented scale of the bank run, what would have been the impact on small banks and small businesses across the nation if you and other regulators had not taken action to protect depositors at SVB and Signature Bank?
Senator, that was our central concern. I think the evidence suggested from the sequential failures of first Silicon Valley and then Signature that there was a significant risk of contagion to other institutions. And in fact, over that weekend, we were seeing serious stress at other institutions. And I think that and the potential knock-on effects of that contagion is really what led the Federal Reserve Board and the FDIC Board unanimously to recommend to the Treasury Secretary.
So you're saying the actions taken were the least bad option for small businesses and banks across the nation. If you hadn't acted that way, you think there would have been a contagion?
I think there would have been a contagion, and I think would be in a worse situation today with consequences for the actors in our economic system that you referenced.
Regulators, Republicans, Democrats, all across the board, there was agreement on those actions.
Yes.
Undersecretary Lang, do you agree with that?
Senator Brown, I do agree with that. I think the actions that were taken have been working to stabilize deposits. Had they not been taken, the runs by uninsured depositors from many small and regional-sized banks and mid-sized banks would have intensified and caused serious problems for small banks' liquidity and their ability to support small businesses.
Thank you. And if you could answer this really briefly, because I don't want to go over my 5 minutes. Chair Gruenberg, the FDIC announced the sale of SVB and to First Citizens Bank and Trust from Senator Tillis's North Carolina. Estimated would cost the Deposit Insurance Fund approximately $20 billion. How's that cost covered?
Oh, that is required by law, and I indicated in my opening statement. The FDIC has to impose an assessment on the banking industry to cover the cost of a coverage for any uninsured deposits. And I would note that the law provides the FDIC authority in implementing that assessment to consider the types of entities that benefit from any action or assistance provided. And as I also indicated in my statement, we expect to issue a notice of proposed rulemaking for public comment in May to implement the assessment.
Thank you. And I would point out in your testimony and your answer, there are no tax dollars, nothing funded through the congressional appropriations process. Senator Scott.
Thank you, Mr. Chairman. What is the future of regional banking? Sure.
I think we have a strong set of regional banks in the United States. I think it was, and as a general matter, their liquidity has remained stable through this episode. And I think it was a good indication, frankly, that in the two failed institutions, in both of those cases, the strongest bids we received to acquire those failed institutions were from two other regional banks that had the capability and strategic business interest to acquire them. So there are a lot of cautionary lessons to be learned from this, Senator. I completely agree with that. And we're going to need to carefully review this episode. But as a general proposition, I think the regional banks in the United States remain a source of strength for the system.
I'd say I walked in on the chairman's comments about the actions that were taken the weekend of the March 9th and how important it was and the importance of making sure we get credit for doing something that actually I thought could have been avoided, frankly. I thought it could have been avoided if we had someone in the private sector make the decision to buy the bank, buy the assets. Had that been done on Friday, March the 10th, I think we could have literally eliminated the fiasco that we saw over the weekend. Were there folks interested in buying Silicon Valley Bank on Friday?
Senator, just to be clear, before the bank failed on an open institution basis?
After.
After the failure on a closed basis.
Yes.
We had expressions of interest. I mean, remember, this was a very rushed process, if I may say. The bank failed on Friday morning. We had to, the other institution failed over the weekend. We had to set up two bridge institutions to manage those failed banks. To your point, though, we had expressions of interest. We quickly set up a bidding process that we ran on Sunday. We received two bids. One wasn't valid because it had not been approved by the board of the bank, and the other, after we evaluated it, indicated that it was more expensive than a liquidation of the institution would have been to the FDIC. So in effect, we did not have an acceptable bid, and it was really a determination that we made to try to set up two bridge institutions to manage for a short period of time these two failed banks, and then to organize a bidding process, an open bidding process for both institutions, which we ultimately were able to implement successfully and sell Signature Bank previous weekend, 2 weekends ago, and then to sell SVB this past weekend.
Are you suggesting that the fact that the board had not approved the decision off the offer that was on the table was the primary reason why you turned down that offer?
It was one of the bids. As a matter of, we were required for a bank to make a valid offer for the board of the bank.
To approve the offer.
Yeah, as a matter
that was the primary reason why you did not go
for
that.
For that bid, the other bid did not have that issue, but the other bid was more costly than liquidation would have been.
So you're suggesting that a private sector engagement would have increased the cost, not decreased the cost?
At that point, I think in part because it takes a bit of time for, this was a substantial institution, it takes some time for a bank to do appropriate due diligence, to evaluate the assets and liabilities, and to make an informed bid for the institution. And I think as a practical matter, that was difficult to do given the compressed time frame over that initial weekend. I think that's why we set up the bridge institutions to try to put in place quickly an orderly bidding process where any interested party could submit a bid, have an opportunity to do due diligence in order to evaluate the institution and to make an informed bid. I think we were ultimately able to do that for both of these failed institutions.
I'll just say with my remaining time that I look forward to the second round of questions, but I will say without question that if we would have had a better private sector engagement with quicker action from the feds, I think we could have avoided the concept that rushed us to a decision, which was a concern of contagion in part. That could have been avoided if we had a decision made on Friday, if there were private sector folks willing to make a decision. But we'll have an opportunity, hopefully, on the second round.
Thank you, Senator Warner from Virginia. Well,
thank you, Mr. Chairman, and thank you for having this hearing. It's good to see all of you. A couple weeks ago, when we were in a Finance Committee hearing, I asked Secretary Yellen that I thought it was very important that we try to get all the facts out about what happened here. I very much appreciate Vice Chairman Barr, you taking on this unenviable task of sorting this out. Because I've got real questions. Was this a regulatory and bank management failure? Or was it, as some on my side of the aisle have indicated, was it a statutory failure? If it was a statutory failure and an additional test or activity was needed, I'm all for putting it in place. But my operating premise at this point is, if this had been not a $200 billion bank, but a $5 billion bank, that management's mistakes, not having a risk officer or other items, and failure of basic prudential regulation should have caught this. We had two chief regulators, a state regulator that at some point, Mr. Chairman, I hope we would get in front to. Where were they? And obviously the San Francisco Fed. So I'm going to be very interested in making sure we get to the bottom of this. I think some of the things you've already pointed out, Vice Chair Barr, is that the bank's business, concentrating in one industry, an industry that I used to be part of, but the fact that there was such high concentration of counterparty risk, my understanding, 10 depositors alone had about $13 billion of deposits. Again, it seems to me interest rate mismanagement is banking 101. And again, even at a $5 billion bank, they should have been called out. I also think the speed, I've often cited the fact that the largest bank failure we've seen was WAMU back in the crisis. $16 billion left that bank over a 10-day period. In this case, $42 billion, the equivalent of 25 cents on every deposit, went out in 6 hours. I'm not sure at that point what regulatory structure could have prevented that. And at least from reports, it seems to me that, and I say this as somebody who used to be in the VC industry, some of the very VCs who banked for a long time at SVB may have started this run and demanded all of their ancillary companies all go out at once. So, Vice Chairman Barr, can you take us through with a little more detail, starting Wednesday night through Friday afternoon, how this happened, how we got here, and what you've seen so far?
Thank you very much, Senator. I'll start where you did, which is this is a textbook case of bank mismanagement. The risks the bank face, interest rate risk and liquidity risk, those are bread and butter banking issues. The firm was quite aware of those issues. They had been told by regulators. Investors were talking about problems with interest rate and liquidity risk publicly, and they didn't take the action necessary. They were quite vulnerable to risk, to shocks, and they didn't take the actions necessary to meet that. What happened on Wednesday night is they belatedly attempted to improve their liquidity position, and they did it in a way that spooked investors, that spooked depositors, that spooked the market. Nonetheless, on Thursday morning, things appeared calm, according to the bank's report to supervisors. But later Thursday afternoon, deposit outflows started. And by Thursday evening, we learned that more than $42 billion as you had indicated, had rushed out of the bank. That's an extraordinary pace and scale. Federal Reserve Bank staff worked with the bank through the afternoon, evening, and overnight to try and find enough collateral that the Federal Reserve could continue discount window lending against. On Friday morning, it appeared that it might be possible to meet the outflow that was expected the day before. But that morning, the bank let us know that they expected the outflow to be vastly larger based on client requests and what was in the queue. A total of $100 billion was scheduled to go out the door that day. The bank did not have enough collateral to meet that, and therefore they were not able to actually meet their obligations to pay their depositors over the course of that day, and they were shut down.
Senator Crapo is recognized from Idaho.
Thank you very much, Mr. Chairman. In your testimony, Mr. Barr, you indicated that you were going to be, in one of the aspects of what you're working on, you're going to be looking at whether more stringent standards are needed. And I want to follow up on Senator Warner's questions relating to this argument that has been put out there, I think, as a part of the blame-shifting game, and there's a lot of that going on right now, that it was a statutory failure. That brings us to the 2018 reforms, Senate Bill 2155. And I just want to read to you a couple of sentences out of Senate Bill 2155 with regard to the question of whether that legislation prohibited our federal regulators, and particularly the Fed, from doing anything they needed to do with regard to applying the appropriate strict standards. And to start out with, I will read what Senate Bill 2155 did was to stop a one-size-fits-all system and mandate, by changing the word may to shall, mandate that the Federal Reserve tailor its regulations to the risk and so forth. I want to read the language. It mandates that the Federal Reserve differentiate, as it tailors, differentiate among companies on an individual basis or by category, taking into consideration their capital structure, riskiness, complexity, financial activities, including financial activities of their subsidiaries, size, and any other risk-related factors that the Board of Governors deems appropriate. And then at the conclusion of the statute, of that section of the statute, it makes it crystal clear, and this is the statutory language. Nothing in subsection A shall be construed to limit the authority of the Board of Governors of the Federal Reserve System in prescribing prudential standards under this section, or any other law, to tailor or differentiate among companies on an individual basis or by category, taking into consideration their capital structure, riskiness, complexity, financial activities, including financial activities of their subsidiaries, size, and any other risk-related factors that the Board of Governors deems appropriate. And I could go on with multiple times that language was repeated. My question to you is, was there any statutory restriction faced by the Federal Board of Reserves as it issued its regulations on tailoring that would have prohibited them from applying the strictest standards they could to address the prudential needs of our banking system?
Thank you, Senator Crapo. I agree with you. There was substantial discretion under that act for the Federal Reserve to put in place tailoring rules that were different from the tailoring rules that it put in place in 2019. I think there is still to this day a substantial discretion in changing those by notice and comment rulemaking. That's one of the areas that we'll be looking at in our review, whether there should be appropriate changes. There are some areas for, particularly for smaller firms between 50 and 100 billion, where the act is more prescriptive. But for the firms of the category that we're addressing today, there's substantial discretion for the Federal Reserve to change those rules in a way that is supportive of safety and soundness and financial stability.
Thank you, and I appreciate your answer. You said recently that the bank failed, referring to SVB, as the public began to focus on changes in values of securities in the bank's held-to-maturity account. That's correct, right? My question to you there is, did the standards on that risk that are used for supervision, Were those changed at all in Senate Bill 2155 in 2018?
The standards for capital rules are determined by the bank agencies. The bank agencies made a decision to, for smaller categories of these large banks, to not require the pass-through of AOCI into the capital structure. But that was a decision that is available to be altered by the discretion of the bank agency.
And was not mandated by 2155?
No, it was not mandated by 2155.
Last question is, under the current standards that are applied with regard to capital, was SVB adequately capitalized?
Prior to its failure, it was categorized under current capital rules as well capitalized.
All right, thank you very much.
Thanks, Senator Crapos. Senator Cortez Masto from Nevada is recognized.
Thank you, Mr. Chair. Thank you, all three of you, for being here. Vice Chairman Barr, let me start with you. You've talked about how the Federal Reserve is undergoing an investigation to determine whether the Federal Reserve actually failed in this instance. Is the Federal Reserve the appropriate body to conduct this investigation, or should we have an independent investigation?
Thank you, Senator. It's a terrific question. We describe what we're doing as a review. We're reviewing our own practices. I think it's an important part of risk management to do self-assessment. I think it would be irresponsible and imprudent of us not to do self-assessment. We're going to take that very seriously. We're going to be thorough. We're going to be transparent, and we're going to be far-reaching in that self-assessment. I also think it's appropriate for outsiders to have independent reviews, and we expect and welcome independent reviews of our actions.
And if you uncover in your investigation that the Federal Reserve failed here in some of its supervisory roles, will you make that public?
Yes, we intend to make our report fully public on May 1st, and that report will include, normally it's not our practice to include, but that report will include confidential supervisory information such as the exam reports.
And in the scope of your review, you identify the scope of that review in your written testimony. Is there anything in addition that's not in your written testimony that you will be reviewing here in that scope?
Thank you, Senator. I've asked the staff to be far-reaching. So if they determine that an issue should be in scope, they have full discretion to put that issue in scope and to address it in the review. So there are no limitations on their ability to review how the Federal Reserve conducted its supervision and the regulatory oversight of the firm.
Thank you. And then one final thing, because there's been a lot of discussion about the previous rollback of some of the regulation in votes in this body just recently. If you find that that change in the law impacted the Federal Reserve's ability to conduct the appropriate tests based on the tiering of the bank's assets, would you be forthcoming with that and say so?
Yes, we intend to describe where we think supervisory and regulatory failings occurred. If changing those to make them what we think is the right standard would require an act of Congress, we will say so in that review.
And then Chairman Gruenberg, same to you. You're conducting a scope of the FDIC. Are you comfortable that you can conduct that and be transparent and accountable, or should there be an independent body looking at this?
I think there's room for both. As Michael indicated, I think it's important for each of our agencies to look internally at our supervision of these institutions and draw lessons from it. In our case, we've asked our Chief Risk Officer, who's not directly involved in the supervision process and whose role is to evaluate risk at the FDIC, to undertake this internal review of our supervision of Signature Bank.
Thank you. And then there's been a lot of talk in the media about the executive salaries, about the executive bonuses, about the sale of stock. Let me ask the three of you. My first question is, what authority do you have to claw back any of those bonuses or the executive pay, or even deal with the sale of the stock? And maybe, Mr. Gruenberg, let's start with you and then go down.
Thank you, Senator. You know, as I indicated in my opening statement, the FDIC, for every failed institution, is required to undertake an investigation of the conduct of the members of the board, the management of the institution, as well as professional service providers and other institution-affiliated parties. We've already begun that investigation, and we have significant authority under the law, depending on the findings of the investigation, to impose civil money penalties, restitution, and as well bar individuals from the business of banking. So the authorities are substantial, and we're going to pursue this as expeditiously as we can. I know there's interest. We do not have, under the Federal Deposit Insurance Act, explicit authority for clawback of compensation. We can get to some of that with our other authorities. We have that specific authority under Title II of the Dodd-Frank Act. If you were looking for an additional authority, specific authority under the FDI Act for clawbacks, probably would have some value here.
Thank you. Mr. Barr.
Thank you. The board does have authority to pursue actions against individuals who engage in violations of the law, who engage in unsafe or unsound practices, who have engaged in breaches of fiduciary duty. We retain this authority even after a bank fails. And we stand ready to use this authority to the fullest extent based on the facts and circumstances. And as with Chair Grunberg, potential consequences include a prohibition from banking, civil money penalties, or the payment of restitution. We intend to use these authorities to the fullest extent we are able.
Thank you. Ms. Lang, and I know, with the chairman's indulgence.
Yeah, briefly, Ms. Langston.
Yes, I defer to the FDIC and Federal Reserve on this.
Thank you. Thank you, Mr. Chairman.
That was brief. Thank you, Madam Undersecretary. Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman. First of all, thank you to all of you for appearing before our committee today. Vice Chair Barr, in your testimony, you said that in November, the Fed supervisors delivered a supervisory finding on interest rate risk management to Silicon Valley Bank. As you know, the communication of supervisory findings must be focused on significant matters that require attention. Matters requiring immediate attention, or MRIAs, are matters of significant importance that the Fed believes need to be resolved right away, including matters that have the potential to pose significant risk to the safety and soundness of the banking organization. My question, Vice Chair Barr, was managing interest rate risk listed in the MRIA section of the supervisory finding issued to SVB? And if it was not, why not?
Senator, we're still reconstructing the supervisory record. We've just started the review, but my understanding is that they were issued a matter requiring immediate attention based on the inaccuracy of their interest rate risk modeling. Essentially, the risk model was not at all aligned with reality.
A pretty interesting statement, if it was not aligned with reality. I recognize that you're going to have a complete report, and I'm not going to try to push you too far into this, but I'm really curious. What's the time frame that's expected for a response for an MRIA, one that requires immediate attention?
Senator, there's not a fixed amount of time. It depends on the issue, the scope of the issue, the complexity of resolving the issue. So I don't have a way of giving you a firm baseline on the action, but they're expected to be a top priority for management to address. And particularly in the interest rate environment that we're in, and knowing that the firm had been cited previously for other problems with liquidity risk management and interest rate risk management, supervisors would expect that would take a high priority attention by top management. The supervisors met with the CFO of the firm in the fall, in October of 2021, to convey the seriousness of the findings directly.
During this time period, perhaps for as much as 6 months during that previous year, the bank was without a risk management officer. Is that correct?
That's my understanding. I think it's terrible risk management, obviously, not to have a CRO at the firm. You need an effective CRO as part of risk management of the firm. And as I indicated previously, the supervisors had told the firm in the summer that they had deficiencies in governance and controls at the management level and the board level, and that was related to their failure to appropriately manage risk.
My understanding is that there was a period of time there in which they were without a CFO as well. Is that correct?
I don't have the details of that, but I'm happy to get back to you.
Okay. And I recognize that there is a difference between a matter requiring immediate attention and a matter requiring attention. Can you kind of share with us the difference? I mean, there clearly is a defined difference between a matter of such importance that it requires immediate attention versus one where it requires attention. Can you talk a little bit about what the expectations are between the two?
They both really signal that bank management should pay attention to what's in front of them. They're not issued lightly. A matter require immediate attention is, as its name suggested, telling managers that they should place a priority on fixing this issue over other issues. But the exercise of the line between the two is a matter of supervisory judgment.
Just to follow up a little bit, and recognizing once again that we'll get a full report in the next couple of weeks, but it seems to me that when it turns into an MRIA, there is an expectation that the board or the executive officers would respond fairly quickly. To your knowledge at this point, was that expectation met?
Well, I think the fundamental fact is, the firm failed because of its interest rate risk and its liquidity risk, and that is, I think, evidence of the fact that they didn't respond strongly enough and promptly enough.
In other words, with the information that you had and that the regulators had, they were able to determine that there was a problem at the bank, and they directed that there be a response immediately, an immediate response, based upon the data that they were able to gather at that time. That's a reasonable assumption, is it not?
I don't know what the time frame set out in each of the individual orders were, so I'm not able to answer your question with precision, and I want to be very careful to be able to do that.
That's fair.
And not go beyond the record.
Let me just finish with this, though. But we will receive that information when the full report comes out.
Yes. On May 1st, we'll release the full report, and it will include the reports of examination. And so people will be able to see what's in the record.
Very good. Thank you. Thank you, Mr. Chairman.
Senator Menendez of New Jersey is recognized.
Thank you, Mr. Chairman. In 2018, Congress passed a bill which was signed into law by President Trump that relaxed regulation for institutions like Silicon Valley Bank. That law, which I opposed, exempted those banks from enhanced prudential standards, stress tests, raised the threshold at which a bank would be considered systemically important. But even as that law kept Silicon Valley Bank off the list of systemically important institutions, the Fed and the FDIC rightly cited systemic risk to justify their actions to prevent runs on other banks. So, Mr. Barr and Mr. Gruenberg, each of you voted to invoke what is known as the, quote, systemic risk exception. So with a simple yes or no, can you tell me that the situation at Silicon Valley Bank posed systemic risk?
Thank you, Senator. I think it's an absolutely crucial question. The invocation of the systemic risk exception required judgment as well as incoming data. And our best assessment, the assessment of a unanimous Federal Reserve Board and a unanimous board of the FDIC and the Treasury Secretary, was that we were seeing signs of contagion in the banking system that threatened to put at risk depositors and banks across the country. And to make sure that banks could continue to lend in their communities, to make sure that depositors were safe, to make sure that businesses could pay payroll, well, we thought it was important to invoke that systemic risk determination and prevent that.
Because you felt that Silicon Valley Bank was a systemic risk at that point in time?
The judgment was really broadly about the risk that the failures of these institutions and other stresses in the system were posing as a whole, as opposed to a particular decision.
It seems to me that sounds like a distinction without a difference. If any single bank's failure can cause contagion that threatens the system, then it seems that the bank should be considered systemically important. And so we need to, you all need to have an obligation to be clear with us and with the American people when you took extraordinary steps to protect uninsured depositors that could very well lead to increased fees charged to banks and ultimately to consumers. So I think we need to be clear about what is a systemic risk. And so I'm looking forward a more crystallized version of that. I was here in 2008. I don't want to live through it again. Do you agree with President Biden's statement 2 weeks ago that Congress should strengthen rules for banks to make it less likely that we will see another failure similar to that of Silicon Valley Bank?
Thank you, Senator. I think it's important for us to strengthen capital and liquidity rules. We're working on strengthening them as part of our Basel III reforms and our holistic review of capital. And I think we need to move forward with that. And as both Chair Grunberg and I suggested, with a long-term debt requirement that would provide an additional cushion in addition to capital for large institutions. That work will need to go through notice and comment rulemaking. There will be transition periods for it, but I think that is really important work for us to do, and I'm committed to doing it.
Well, let me ask you, Mr. Barr, this morning I, along with Senator Rounds and other members of this committee, sent a letter to Chairman Powell asking him to explain whether the Feds applied enhanced supervision or prudential standards to Silicon Valley Bank or any similar sized bank using the Fed's existing authority. We've also learned from public reporting that Fed supervisors began flagging problems as a SVB as far back as 2021. Now, I understand we have a lot more to learn about the facts of what transpired, both at the bank with any management failures, but I expect that we're going to see that all factored in as part of a review. So as you begin that review, let me ask you, do you agree with Chairman Powell's statement last week that from what we know, it is, quote, clear that we do need to strengthen supervision and regulation?
Yes, I absolutely agree with that statement.
Thank you for that. Now, lastly, what I would love to know, Mr. Greenberg, about as we think about should we raise the federal deposit insurance, what percentage of account holders does that account for, how much is private versus business, and what are the costs that are associated with it. So I'll just put that out there for you to submit an answer to the record because it will take more time than what I have. But the last point I want to make is we have seen a flight from regional and community banks to quote-unquote too big to fail banks. And a concentration of deposits at a select few institutions also brings about its own risks to the financial system. At the end of the day, it seems that we are incentivizing entities to go to too big to fail banks. It only makes it even more consequential in terms of too big to fail. Is that what we want to ultimately achieve in this process?
Senator, I think that the goal of the actions that we took are to make sure that we have a thriving and diverse system of banking in the United States, including community banks and regional banks that are the lifeblood of many communities all across the country.
Thank you, Senator. Senator Kennedy, Louisiana, is recognized.
Thank you, Mr. Chairman. Thank you all for being here today. Chairman Barr, the Federal Reserve stress tested 34 banks in 2022. Is that correct?
Senator, I don't have the exact number in front of me, but that
I have your report.
I have your correct.
Report. It says 34. And the cutoff was $100 billion. Is that right?
Yes.
Okay. You didn't stress test Silicon Valley Bank, did you?
No, under the Federal Reserve Board's rules that were put in place for transition into the stress testing, it takes a while for a firm to be considered above the threshold. Yeah. They need to have a rolling four-quarter average.
Did you stress test Silicon Valley Bank in 2022?
No.
Okay. Silicon Valley Bank had $100 billion, more than $100 billion in assets at the end of 2021, did it not?
Senator, as I was explaining, the transition rules in place at the time require a rolling four-quarter average to be above that amount.
Okay.
And then if the firm happens to be in a year that isn't the year that, since it's an every other year test, that a test is running,
Right.
Then it waits till the next year. So for Silicon Valley Bank, that would have meant 2024 would be its first stress test.
But the point is, you didn't test Silicon Valley Bank.
We did not apply a stress test to Silicon Valley Bank.
right.
It was, of course, using its own stress test.
Did you
as part
have
of
the authority to do it?
Under our existing regulations, no. We would have to change our regulations to have that authority.
Under the Congress's amendment to Dodd-Frank, Senator Crapo talked about it, 2155, Section 252.3. Isn't it a fact that we gave the Federal Reserve the authority to stress test Silicon Valley Bank?
Under that legislation, the Federal Reserve could have put in place a rule defining the word periodic
But you
in a
didn't.
different way than was done.
Right, but you didn't, did you?
The Federal Reserve did not do that.
Okay. If you had stress tests, let me put it this way. If you had stress tested Silicon Valley Bank in 2022, it wouldn't have made any difference, would it?
I don't know the answer to that question.
Well, you didn't test for Silicon Valley Bank's problem. I've read your report. You stress tested these 34 banks for falling GDP, spike in unemployment, and defaults in commercial real estate. Isn't that correct?
Yes, in a typical adverse scenario for banks, we're testing falling interest rate
But that
environments.
wasn't our problem in 2022.
I completely agree
and
with
it's not
you.
our problem today. The problem is inflation, high interest rate, and loss of value in government bonds, isn't it?
I completely agree with you.
So you stress tested in 2022 for the wrong thing.
The stress test is not the primary way that the Federal Reserve or other regulators test for interest rate risk.
But you stress tested for the wrong thing.
As I said, Senator, I agree with you that it would be useful to test for higher rising interest rates. That's why in our alternative scenario, multiple scenario that we put in place for this year's stress test, we do that. These decisions were made before I arrived, but I agree with you that it would
But
be
it's like
better to
somebody
do that.
going in for a test for COVID and getting a test for cholera, isn't it?
I don't know enough about either of those tests to know.
Yeah. Well, they're different. So all this business about, the amendment to Dodd-Frank kept them from stress testing. The way I see it, you chose not to stress test, and if you had stress test Silicon Valley Bank, you wouldn't have caught the problem.
As I said, Senator, I agree with you that the statute requires periodic stress testing. The Federal Reserve made a decision about how to implement that in 2019.
Right.
That resulted in SVB not being tested planned to be tested until 2024.
Well,
but as I said, the stress test requirements.
You knew from the. I'm sorry to cut you off, but the chairman's going to cut me off in a second. But you knew. The Federal Reserve knew well in advance that Silicon Valley Bank had a problem with holding too much of its money in interest rate sensitive long government bonds, didn't you?
I think the investing public and the Federal Reserve, which cited it for interest rate risk problems, knew that it had interest rate risk. I think
the Federal
nobody
Reserve didn't do
anticipated
anything about it, did it?
I'm sorry, I couldn't hear you.
The Federal Reserve didn't do anything about it, did it?
I disagree with that, Senator, respectfully. The Federal Reserve did cite these problems to the bank and require them to take action. Bank management failed to act on those.
You didn't follow up,
citations.
did you?
Senator's time has expired. I think that I sit here and watch Mr. Barr reluctant to criticize some of the moves of his predecessors at the Federal Reserve. I'll leave it at that. Senator Smith from Minnesota is recognized.
Thank you, Mr. Chair, and thanks to our folks for being here today. Really very much appreciate it. So I want to just start by reiterating what I know some of my colleagues have said, which was that as these two banks collapsed, I heard you say very clearly, Vice Chair Barr, the Silicon Valley Bank in particular collapsed because of what looks like gross mismanagement and failure to manage even the most basic of risks, liquidity and interest rate risks. The Biden administration And regulators took strong and decisive action to protect people and to keep our banking system safe and secure. And the reality is that that action that you took was necessary, but it was also extraordinary. Extraordinary actions were called for in the moment. And you, of course, don't want to have to use extraordinary actions. You want to be able to rely on banks to make good decisions and to protect their shareholders and to protect their depositors. But let me just clarify one thing before I want to follow up a little bit on Senator Kennedy's questions. The Fed, under the previous Vice Chair of Supervision, put into place rules that I think there's a question about whether those rules, I mean, I think even in the moment, you were critical of those rules. Is that right?
Yes, that's correct.
And so your review will take a look at what would have happened if those rules hadn't been in place, and then you can make decisions about what new rules need to be in place to protect from this kind of extraordinary situation that we saw with these two banks. Is that correct?
Yes, that's correct, Senator.
So I think that's just important for us all to understand here as we think about what has happened. The Silicon Valley Bank's failure was the result, it appears, of management failures at many levels, all coming together at the worst possible time. And I'm particularly struck by the bank's failure to manage interest rate risk. You and I talked about this last week, which is basic bank management. It's not rocket science to manage interest rate risks. And, you know, interest rates, were near zero for more than a decade, and a lot of business models, it appears, including Silicon Valley Bank's business model, was predicated on basically free money. And that obviously presents risks when that changes. So I'm concerned, Vice Chair Barr, about other institutions, banks and non-banks alike, how they are managing what must be similar interest rate risks. Could you just address that and talk about how the Fed right now and others are monitoring that interest rate risk and what that tells you about where we need to do differently?
Thank you, Senator. Let me just start with the basic point, which is the banking system is sound and resilient. Most banks are highly effective in managing interest rate risk and liquidity risk. It is the bread and butter kind of work of bank management. So we are monitoring the financial system, monitoring the banking system. We're looking at interest rate risk and liquidity risk across the banking system to assess that. Where banks need to do better at interest rate risk and liquidity risk management, we're pointing that out. But I think the fundamental point is the banking system is sound and resilient.
I might have mentioned to you when we spoke that I had a chance to meet with a group of Minnesota bankers, including Minnesota has more community bankers, I think, per capita than any state in the country. And they were eager to point out to me that their business models are very different from the business models of highly risky enterprises like Silicon Valley Bank. And so I appreciate you raising that. In fact, I've been getting texts from some of my bankers today watching this hearing and wanting to point out that difference. Mr. Barr, can you talk about the risks of interest rate, sort of this interest rate risk, as it might affect non-banking institutions, as, for example, mortgage loan companies?
Thank you. First, let me just say, as you indicated, I hear from community bankers as well, and I know many other senators have in your home states, the vibrancy and the health of that community banking sector, and we see that too. We are obviously looking at interest rate risk as it affects not only banks but also the non-bank sector. We look at, of course, at non-bank mortgage servicers, we're looking at hedge funds, we're looking broadly across the financial landscape to see where those risks might arise and how those might propagate in other ways into the banking system. So we're highly attuned to that. But again, I think the basic point is that the banking system is sound and resilient, depositors are safe, and we've, through our actions, demonstrated that.
Thank you very much. Thank you, Mr. Chair.
Senator Smith. Senator Lummis of Wyoming is recognized.
Thank you, Mr. Chairman, and thank you, panel. I want to follow up a little bit on Senator Kennedy's line of questioning. As I read Statute 5365, Section C, risks to financial stability, safety, and soundness. The Board of Governors may order or rule, the Board of Governors may, by order or rule promulgated pursuant to Section 553, apply any prudential standard established under this section to any bank holding company with consolidated assets equal to or greater than $100 billion. So that was Silicon Valley Bank. Then you've got Statute 2155, that when it was changed from may to shall, made mandatory a new duty on the Federal Reserve to take into account higher risk profiles presented by certain banks and to strengthen supervision of those banks. So you look at Silicon Valley Bank. They had a number of activities with above average risk profiles. Their concentration of deposits, the quantity of uninsured deposits, 94% uninsured deposits. Then you look at Federal Reserve Authority under Regulation YY to impose additional risk-based or leverage capital or liquidity requirements or other requirements the board deems necessary to carry out the purposes of Dodd-Frank. I look at all this and I think that among all these statutes and regulations, the Fed had plenty of authority to prevent Silicon Valley Bank and the problems it encountered, and was aware pretty early on that there were unique problems there and that it was a very, very unique financial institution because of its risk profile, but didn't do it. As I look at what authority you've been given, I can't think of another additional rule or regulation or law that you needed. Tell me whether you agree with that or not.
Senator, I agree that the Federal Reserve has substantial discretion to alter through notice and comment rulemaking the rules that were put in place in 2019 with respect to firms over $100 billion. There are some areas that the statute would provide some limitation to, but there is substantial discretion for the Federal Reserve to change its rules for firms in the $100 to $250 billion range.
Change its rules. What would it have to do?
We would have to go through a notice and comment rulemaking process.
Oh, I don't mean the procedure for changing a rule. I mean, what changes would you make to the rule?
Senator, we haven't made a definitive conclusion on that. We're undertaking this review of SVB's failure in order to better assess whether it would be appropriate to change capital rules and liquidity rules for this size firm, for firms more generally. We're looking at that right now.
Is fractional reserve banking overly risky in this age of online banking?
Senator, let me just say, repeat what I said before, which is that overall the safety and soundness of the banking system is strong. Banks are safe and sound. Depositors should feel assured that their deposits are safe.
Well, here's the problem, though. As I see it, the way that these banks have been managed, Wyoming's community banks may end up paying for this through higher assessments from the FDIC. Am I correct, Mr. Grunberg?
Well, as I indicated, Senator, in regard to these two institutions, any cost to the Deposit Insurance Fund from covering uninsured deposits is required by law to be recovered through an assessment on the banking industry.
Exactly.
If I make just one additional point, the law does give the FDIC authority in implementing that assessment to consider the types of entities that benefit from any action taken or assistance provided.
So are you saying that you're able to exempt Wyoming's community banks from paying for this?
I'm suggesting we have some discretion there, and we're going to consider that issue carefully.
Will you exempt community banks from having to pay for this?
That's a judgment our board is going to have to make. And as I indicated, we anticipate going out for notice and comment public rulemaking in May to implement the assessment. And as I indicated, we have discretion
Do you
here
have
under
to
the
go
law.
through APA rulemaking to assess?
That's the law. That's a legal requirement, though.
Thank you, Mr. Chairman.
Thank you, Senator Lemons. Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. So we just experienced the second and third largest bank failures in American history. Executives at SVB and Signature took wild risks and must be held accountable for exploding their banks. And I'll soon introduce a bipartisan bill to do exactly that. But let's be clear, these collapses also represent a massive failure in supervision over our nation's banks. So coming out of the 2008 crisis, Congress put tough banking rules in place. Now, big banks hated them, and their CEOs lobbied hard to weaken those rules. Ultimately, Congress signed off, and then it got bad, really bad. Regulators burned down dozens of safeguards that were meant to stop banks from making risky bets. Now, the three of you here today represent the U.S. Treasury and two of our top banking regulators. I'd like to know if you believe that we need to strengthen our banking rules going forward to ensure the safety of our financial system. Vice Chair Barr, let me start with you. Do you believe we should strengthen our financial rules going forward?
Yes, I do, Senator.
Thank you. President Biden agrees with you as well. 2 weeks ago, he stated that we must, quote, strengthen the rules for banks to make it less likely that this kind of bank failure would happen again. Chairman Gruenberg, what about you? Do you agree with President Biden that we need to strengthen our banking rules?
I do agree, Senator.
Good. And now, Under Secretary Liang, do you agree with the president on this?
Senator, I agree that we do need to prevent these types of bank failures.
Well, I'm asking you, of course we need to prevent them,
supervision
but that's not by simply wishing it. It's by stronger regulation, is that right?
I agree, Senator.
Okay, good. Now, we need better laws here in Congress, but let's also talk about how we can strengthen the rules today, even before Congress acts. Under current law, the Federal Reserve has the discretion to apply stronger prudential standards on banks with assets between $100 billion and $250 billion, exactly the size of Silicon Valley Bank. That authority is not being used right now. Vice Chair Barr, will you use your authority to strengthen rules for the largest banks in this country? As you use your authority to strengthen the rules for the largest banks in this country, will you be reaching banks with assets of at least $100 billion?
Senator, we, of course, would need to go through a notice and comment rulemaking
I understand.
In this process, but I anticipate the need to strengthen capital and liquidity standards for firms over $100 billion.
Okay, so this is the area we're looking at. We're going to push down further in terms of the greater scrutiny. Chairman Gruenberg, let me turn to you. Once the Fed began torching rule after rule in 2018 for big banks, the FDIC, under your predecessor, joined in on the fun and also started weakening FDIC rules across the board. Capital and liquidity requirements, stress tests, you name it. In fact, your predecessor explicitly told these banks that if FDIC bank examiners were asking too many questions, that they should, quote, let us know, end quote. Now, there's a banking regulator who makes it clear that she is there to serve the big banks instead of the American public. Chairman Gruenberg, will you commit to using your authority to undo the rollbacks that your predecessor initiated and to strengthen the rules and supervision for banks with greater than $100 billion in assets?
Senators, I think you know I was a member of the board at that time and voted against those measures. And I certainly think it's appropriate for us to go back and review those actions in light of the recent episode and consider what changes should be made.
Well, I have to say, review sounds a little wishy here. You didn't think they were good rules to begin with.
My views haven't changed, Senator.
All right, so you still think they were a bad idea?
I do.
Got it. You know, each of you at this table has authority that you could exercise right now to strengthen rules for big banks and to ensure that our banking system and our economy are safer. I urge you to use that authority, and I urge my colleagues here in Congress to do our part to protect American families and small businesses from yet another banking crisis. Thank you. Thank you, Mr. Chairman.
Thank you, Senator. Senator Haggerty from Tennessee is recognized.
Thank you, Mr. Chairman. If you would allow me just a moment to speak to the tragedy that occurred at the Covenant School in Nashville, Tennessee yesterday. A depraved person, a sick person, executed a tragic act and yielded a terrible result. And my entire community is mourning. We're mourning for the families, for the victims, for everybody concerned. I also want to acknowledge the bravery of the Nashville Police Department. They stepped into harm's way and within 14 minutes brought the situation under control. Tremendous bravery at a time when it's called for, and I want to acknowledge their sacrifices. Now let's turn to the matter at hand. And I know that politics in Washington always seizes upon any crisis as an opportunity to achieve whatever regulatory or legislative opportunity or goal that may be in front of them. But I'd like to talk about managerial execution here. Specifically, I'd like to start with you, Chairman Gruenberg. I'd like to talk through a series of events that followed SVB's failure 2 weeks ago. As you know, Silicon Valley Bank was taken into receivership on a Friday morning. That gave the FDIC 3 days to find a buyer before markets opened on Sunday night. You had tremendous resources at your disposal. 18 years of experience on the FDIC board yourself. Detailed resolution plans. Over 5,000 employees and interest from a number of banks to bid, including at least one formal offer, as I understand it. Instead of successfully executing this process, however, the FDIC used the systemic risk exemption to guarantee all deposits at SVB, creating tremendous uncertainty across our economy. And now, 2 weeks later, the FDIC has announced the sale of less than half the failed bank's assets at a loss of $16.5 billion. So my first question, in the joint statement released on March 12th, you said, quote, no losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayer. Is that still your position?
Senator, yes, as you know.
Well, the problem is, with 2 partial sales completed and over $22 billion in losses already accrued, that position just doesn't square with reality. These losses are borne by the Deposit Insurance Fund. That fund is going to be replenished by banks across the nation that had nothing to do with the mismanagement at Silicon Valley Bank or the failure of supervision here. In fact, that's going to be addressed by a special assessment to those banks. And as we all know, these banks will have to pass these costs along. Last time I checked, those costs that get passed along to the consumer, those consumers are American taxpayers. Chairman Gruenberg, invoking the systemic risk exemption is a last resort emergency option to the typical methods of resolution, and it begs the question of why you had to invoke that extraordinary exception. Just this past Sunday's announcement of a new purchaser, part of SVB, not only were serious losses incurred, but the FDIC entered into a loss-sharing agreement with the acquiring bank, and a $70 billion line of credit was extended to the purchaser. That's a pretty sweet deal. And this makes me wonder what prevented the FDIC from coming to a deal like this 2 weeks prior. You told Ranking Member Scott that you received bids for SVB over the weekend following its collapse, but that they were insufficient. What was your counteroffer? And did you engage with the board of the bank that didn't approve this to get them to step up and approve it?
We received one offer that was frankly more expensive than the cost of liquidation. Didn't appear to be a viable offer at that moment.
Was there a counteroffer to that?
I would have to check with our staff in terms of how much of a back and forth occurred.
Let's talk about the bidding process itself. Were certain banks dissuaded by you or anyone else associated with this from bidding on SVB, either before or after the bank was taken into receivership?
No, Senator.
Throughout the course of that weekend, I was inundated with phone calls telling me that legitimate bidders were being waved off of the process. It's one thing to reject a bid if it's bad, but if ideology had anything to do with this entire committee is going to be deeply concerned about that. I look forward to the GAO's report on this because the result of this failure places the banking sector in a state of disarray that we've never seen before. In spite of all the preparation and tools at your disposal, the FDIC failed to do its job. There was obviously enough demand to orchestrate a sale. What it looks like to the American people is that you simply didn't feel the incentive to execute, and leaned on the systemic risk exemption to buy time, and in doing so, have placed the entire U.S. banking sector into uncharted waters. I don't see any apparent improvement in outcome, and this is a disgrace. I look forward to the GO review, and I hope that we get to the bottom of this. Vice Chair Barr, very quickly, I'd like to come to you. In response to the 2008 financial crisis, the size and scope of the regulatory regime was dramatically expanded by Congress. Regulators like yourselves are giving powers, not to mention hundreds of academics at your disposal, with the sole job of monitoring and addressing risk to the financial system. All of this was in hopes of identifying and preventing bank failures that pose systemic risk. And in spite of all these tools, we find ourselves in a situation today that is unprecedented. It's pretty clear that Silicon Valley Bank was woefully mismanaged. Their management team, which didn't have a chief risk officer for 8 months last year, yet created and maintained a chief diversity, equity, and inclusion officer, allowed their bank to accumulate truly shocking levels of risk. And while this was occurring, the San Francisco Fed was focused on researching left-wing policies that they had absolutely no expertise in, ignoring one of the most basic risks in banking, interest rate risks. Perhaps most damning of all, until the day of their failure, SVB's CEO sat on the board of the San Francisco Fed. So, Mr. Barr, in your review of what went wrong in your supervision, will you consider the level of managerial distraction that was evident at the San Francisco Fed?
Senator, the staff have free rein to examine any issue that might have addressed supervision. I think the core issues are the ones I suggested at the outside, and they're really basic. Interest rate risk mismanagement by the bank, liquidity risk mismanagement by the bank. The San Francisco examiners, the examiners at the San Francisco Federal Reserve Bank called those issues out to the board, called them out to the bank, and those actions were not acted upon in a timely way. And so I think in a way the issue is pretty straightforward.
The sense of urgency that was brought to bear on this, and the sense of pressure, and if every tool at their disposal was used, because they certainly were doing other things well beyond their remit. Thank you. Thank you, Mr. Chairman.
Absolutely. Thank you for your questions. I'm going to ask the questions now, if I might. In 2008, I voted against the bailouts of the big banks because I don't support taxpayer bailouts. We do need to protect American consumers and small business folks. We need to hold bank executives accountable when they screw up. And if the regulators are asleep at the wheel, we need to hold them accountable. Look, a correlation I would say is when I run my farm, if I look at the price of diesel fuel and seed, and that's all I look at, I don't get the whole picture. And quite frankly, I won't be in business long. If regulators are only looking at capital, that isn't everything that's going on. At Silicon Bank, they had a concentration in a highly volatile industry. They had grown rapidly, had mostly uninsured deposits. Their investments were poorly timed with interest rate increases that were clearly forecasted, all setting the conditions for a classic bank run, one that happened quickly due to new technologies that are out there. So, Vice Chair Barr, from 2020 to 2022, the Silicon Valley Bank grew from 71 billion to more than 200 billion. This was a very rapid growth. It was heavily concentrated with techs and startups, industries that have always been volatile. Then the bank took those mostly uninsured deposits and invested them in long-term U.S. Treasuries when the Fed had been clearly forecasting that rates were going to go up, which the bank executives should have known because their CEO was a director at the San Francisco Fed. And for 2 years, it seems that federal regulators were flagging concerns about this situation. Is that a fair statement, that for 2 years that the Fed was flagging concerns about this bank's financial viability?
Senator, the examiners were focused on interest rate risk and liquidity risk at the beginning in November 2021. There, at least as far as I know from the supervisory record thus far, I have not seen something that said that the supervisors were focused on whether the firm was viable. But our review is underway.
But doesn't that impact the viability?
Yes, Senator, is a core safety and soundness risk. A liquidity risk and interest rate risk are core risks that the bank mismanaged.
So were the regulators physically in the bank? So I've talked to a lot of intermediate-sized banks. They tell me that the regulators are right there 5 days a week, 7 days a week if they're open 7 days a week. Were the regulators in that bank?
Physically speaking,
Yes.
I actually don't know. The part of the supervisory period is during the pandemic when activities were happening
I've got you.
in part remote. So
Okay.
I don't have yet, but we will
But
have.
I just want to point out the fact that the pandemic's been over for quite a bit, and the opportunity for those regulators to be in there would have been long before a month ago.
Yes, Senator, I don't have the full supervisory record. We've just begun our review, and I want to be very careful to answer only questions I know.
Do you know if the Fed supervisors met with the board of directors of Silicon Valley Bank?
I don't know that yet. I know they met with senior management, but I'm still reviewing
So
the
you
record.
wouldn't know if Silicon Valley Bank had a risk committee and if, in fact, the Fed supervisors met with the risk committee?
I will know that by the May 1st report.
So were they warned about potential fines?
I'm sorry, could you say that again?
So, I mean, look, they had some problems. Were they warned to either fix them or they were going to get fined?
The matters requiring attention and matters requiring immediate attention, to my understanding, require the fixing of the problem, but I don't know whether they've highlighted any additional steps that might be taken. Certainly, the firm was on notice that they needed to fix those problems quite clearly since November of 2021.
But yet they didn't.
They did not.
So what point in time does the Fed regulators drop the hammer on this outfit? I mean, I don't even need to get going on the bank CEO taking a ton of money right before this thing went belly up, as it was going belly up. At what point in time, we can have all the regulations on the book. I've talked to a lot of bankers who said if this had happened before Dodd-Frank, the regulations were there to stop this to happening. And we have Dodd-Frank. And we did make 2155 to tailor the regulations to fit the risk. That was a big part of it on the intermediate banks, and in fact on the small banks too. But yet, for over a year, and correct me if I'm wrong, Mr. Barr, for